This is the final and most important video in this series. Today we are learning how to take everything you've learned so far and put it all together to create a robust and fortified trading system that stands the test of time. It's time to take your trading game to an entirely new level. Confluence is the word we use when weaving together multiple trading concepts. By using concepts in conjunction with one another, we increase our probabilistic odds of success. We can use a points-based system again to illustrate this. Let's say that we mark our setups out of 10 and each of the concepts we've studied are worth 2 points. Here we have an example of a highly confluent setup. We have a sharp, inefficient move down. We have our first 2 points. At the end of this move, we form a bullish divergence. That would be another 2 points, bringing us to 4 points. Now, if that divergence was occurring whilst sweeping a key low, we could give it another 2 points, and now the setup has 6 points. Let's say that it also occurred into a demand zone, sat the other side of the key low being swept. We give it another 2 points, bringing it to 8 points. And finally, as this setup forms, we get high negative delta, resulting in a final 2 points, totaling 10 points. This, my friends, is what we mean by confluence. What we're doing is harmonizing our knowledge and utilizing our tools in a way that gives us a much better chance of winning the trade. Many that don't understand trading refer to it as gambling, and in truth, it can be a very viable outlet for gamblers. But when we trade in a confluenced manner, we are trading with a professional approach, only putting our risk on the line when we have great faith in the play out. The example we've just run through is a great illustration of this. And although it would be incredibly rare to have all of the stars aligned to that degree, we can start working out what levels of confluence we need to enter trades and ensure we have them present before doing so. But in order to understand how much confluence we need, we have to, for one last time, revisit our old friend, context. Context is absolutely critical when thinking about confluence. While it is true that heavily confluent setups are the best way to approach trading, generally speaking, we also need to know when to employ this approach. Most of the time, the market will be range-bound as opposed to trending, but there will be times when the market is hyper-directional, for instance, raging upwards or downwards. As a result, in the majority of cases, we should maintain that we want to see multiple layers of confluence come together, but when in these trending conditions, the market will rarely give you them. Instead, we'll present one or perhaps two concepts that align. To make things simple here, use the following guideline. When the market is non-directional, we must keep confluence high. But when the market is undeniably directional, we can start to lower our confluence. Think of this as an inverse relationship. The less trending the market is, the more confluence is needed, and the more trending the market is, the less confluence is needed. It's very rare that the market is in a hyper-trending state, and for the majority of the time, your fortified, confluenced approach is the way to go. So this is where I'd focus your efforts, simply understanding that if we do migrate into these rarer trending conditions, that you should approach the market with less stringency. The example I gave at the beginning of the video is an example of extremely high confluence, but as mentioned, a setup to that degree of confluence will be tough to find. So let's run through some actual setups that occurred in Bitcoin over the last few months. A note to anyone watching these videos in years to come, these teachings are still applicable and are evergreen concepts, meaning they have stood the test of time and will likely continue doing so. I highly recommend you watch all of these examples and let them wash over you in a sense. You'll come out of the process having a very good understanding of what you're trying to look for. Let's take a look at our first example. A delta and speed-led anticipated deviation using a divergence as the trigger. Here we have an hourly bullish divergence on the RSI that occurred past a higher time frame key low after an aggressive and fast move to the downside. Dive down to the 30 minutes and you can see that we now have our double divergence present. Whilst doing so, we put in a large amount of negative delta and liquidations, producing what we call a large delta event. This play was an anticipated deviation, taking the more aggressive entry at the hourly or 30-minute divergence confirmation, but was supported heavily by the delta and liquidations that made the more aggressive approach favorable. This trade could be taken to this level where we start to see the presence of positive delta and liquidations on the reverse side. All in all, it's a classic wipeout and a great example of reversion in the markets. Here's what it looked like in motion. On to our next example, a divergence-led trade with delta and a local sweep to support. Here we had an hourly double divergence as we took out a high from a few days beforehand, and in forming the divergence we also put in a local sweep. Whilst this occurred, we had the highest single bar of positive delta on the page. This then deviated the high and could have been taken all the way down to 50k to the previous example we just looked at. This was a simple play leaning into both delta and divergences. Here's it in motion. On to our next example, a sharp high delta move into demand with divergences and a local sweep to support. First off, we have a zone of 2-hour origin demand present. Price travels relatively fast into this zone, and as it does so, we produce high negative delta and liquidations. We then start to form an AO divergence on both the 30-minute and hourly. We hardly have RSI confluence due to its structures, but as we've already ticked a few boxes, we can think about taking the position. Finally, we put in a local sweep and start pushing up. This trade could have been taken all the way to the highs we observed as entry for the last trade, where we produced the hourly bearish divergence. This play is a great example of using both confluence and your best sense to take a position. Here's it in motion. On to our next example, a sharp spike into demand after producing heavy delta. First off, we wipe out a key higher time frame low, and as with the first example, do so aggressively and with speed. Subsequently, we produce a ton of negative delta and liquidations. There wasn't quite an entry trigger here, but at the lows we created a pocket of hourly origin demand. Price then revisits this zone a few days later and taps into demand, again doing so with relative speed. Of course, we don't see quite as much negative delta produced as the first move, but still a significant amount. Due to the initial production of delta, our minds are naturally looking for a reason to enter on the long side, but simply need a technical trigger to warrant entry, which we get with the move into demand. This trade could have been taken up to 66k, where we produce a cluster of positive delta that, although counter trend, we simply cannot ignore. This is a classic liquidity and delta based trade, and here's what it looks like in motion. On to our next example, a divergence and delta-led trade with a shallow local sweep to support. Here we have a 2-hour double bearish divergence, and although only just, as the candle bodies are only slightly making higher highs, it's still valid. We do so into a cluster of 12-hour supply, and we get some nice spikes of pro-trend positive delta. Remembering our newfound knowledge about the power of pro versus counter trend delta, we have a nice setup forming to play into the trend. Finally, we get a lower time frame local sweep before this starts moving to the downside and go on to produce a divergence confirmation candle. This would then have played down to the large negative delta event that occurred in the previous example. A simple trade listening to the oscillators and leaning into the delta to join the trend. Here's it in motion. Onto our next example, a high delta producing sweep to join the trend. Here we have a classic pro-trend play. We are very aware that the trend is down and are subsequently looking for shorts. As the trend is strong, we should be willing to drop our criteria necessary to enter ever so slightly, again taking context of the trend into account when putting together our trade theory. Price spikes up and sweeps this local hourly high. We have no divergences present, but we do have speed, and as long as we have one or the other, we have a valid play on the price action front. As we make this move, we produce a couple of nice positive delta bars, giving us all we need to enter. This trade would have probably taken itself down to 59k, where we take out a key low and put in a lot of negative delta and liquidations. A typical trend joining trade. Price spikes up, stops out shorts, and continues. Here's what it looks like in motion. On to our next example, a delta-led anticipated deviation using divergences to support. Yet again, another wipeout of a key higher time frame level. In doing so, we start forming a funny structure on the oscillators. The hourly RSI is technically invalidated, as it's gone past the point of being flat bottomed, and the AO isn't diverging, but the structure of the RSI divergence is very clean in its arced formation. A zoom down to the 30-minute and we can see that we have a technically valid double div, although only just, that occurs after the hourly divergence in question. This would have been tricky to read and a great example of when and how to bend the rules using divergences. Here we had taken out a key level, done so with speed, and as you can probably guess, put in a lot of negative delta and liquidations. In cases like these, you have to use your common sense to determine what you think price will do, and in this case, it was indeed the formation of what would be looked back on as a deviation with a nice play out. This could have either been taken to 65 or 70k, where we start seeing significant delta on the positive side. All in all, again, it's a great example of a classic wipeout reversion trade, and here's what it looked like in motion. On to our next example, a harmony of many concepts: speed, divergences, sweeps, liquidity, and delta. Here we take out a cluster of highs on the hourly and do so with speed into 4-hour origin supply. Rolling down to the 50-minute, we have a clean double divergence that forms into the base of this supply zone. Over to the delta, as I'm sure you've guessed, we produced high positive delta in doing so. This could have been taken down to 61k, where we take out a key low and produce high amounts of negative delta. A beautiful tapestry of theory. Here's it in motion. As you can see, there is no one-size-fits-all or black and white approach we can apply to the markets. Instead, we need to use our common sense and utilize the concepts in harmony with one another as we best see fit, not being either too rigid or flexible with the rules. These nuances are why people refer to trading as discretionary and will only come with screen time, experience, and reflection through journaling. But just know that you have taken huge strides in this series and are now equipped with a strong technical footing that will serve as your foundations as a trader. Time to get in flow.